Markets and Bitcoin and crypto are dipping today on the job report news. Let's jump in, take a look at what is going on. They always show this guy when the market is down. That's a scary looking face right there. Not bad right now. Markets were down the Dow was down about 1.5% at one point. S&P was down about 1.5 as well. NASDAQ was down about the same. Everything down almost 1% across the board with about 30 minutes left to go until the close. As I always say, watch the momentum into the close. That kind of gives you an idea of what the markets are really thinking. This could rebound, break out to even by the time we close, or it could continue to break down. But the issue is the job reports, came out today where the economy added a lot more jobs than was initially projected. 339,000 jobs were added in May when the economists were expecting 240,000. So much for the economists and the analysts, right? And so what does that mean? Why is the market reacting so strongly to that? So one, obviously that gives the Fed more cause to go ahead and raise rates at the next meeting, when the market was kind of expecting the Fed not to have to raise, thinking that jobs were going to be okay, that inflation was going to continue to come down, and that the Fed probably would not have to hike at the next meeting. But it's not just the next meeting. What this indicates now with the strength of the jobs market, the Fed indicated in the minutes that they thought that, albeit slow, that they were making progress, with inflation and with jobs. This shows that they do not, that they have not made an impact, that they are not in control, and that this will likely potentially can lead to more inflation for two reasons. One, you're adding spendable income to the economy. We're a consumer-based economy. So when people have jobs, they spend more, which is what increases inflation, puts pressure on prices, more demand, higher prices, things like that. So the Fed did not have a grip on inflation to begin with. They don't have a grip on the jobs market, and they do not have a grip on the economy. So what the markets are now fearing is that there could be as many as 4 more 25 basis points hikes out of the Fed. But, higher for longer, definitely. And, the expectations are 98% for a 25 basis point rate hike, which isn't much in and of itself. But again, it's the expectation now that the Fed is completely out of control. We might see a double peak inflation. Jobs are going to continue to be strong. We've got more job data coming out tomorrow. And then we have inflation coming out, inflation reports coming out in the middle of the month, ahead of the Fed meeting toward the end of the month. So right now we can expect 25 basis points. I doubt they'll go 50. Powell just doesn't have it in him to do what is needed to do to slow the economy. It's becoming more and more imminent that is true, and that's what the markets are thinking about and fearing right now. However, there's still a lot of liquidity out there, still a lot of liquidity on the sidelines. Retail investors are still chasing the bubbles. So that's the thing that's kind of counteracting. The government is still spending, which is in contradiction to the Fed policy, trying to slow the economy. The government is trying to stimulate growth, create jobs, and keep the economy humming. So this could take a while to play out. The markets were expecting a soft landing. So now hard landing is back on the table with this jobs report. The only way to really affect inflation, slow down the economy, is for a harder landing. So that's kind of what the markets are digesting. We'll see how this plays out over the next couple of days. In the meantime, we're at the correction levels that we've been talking about, where these are very pivotal levels for the market, where if they don't get past these levels, then this is the point where markets generally roll over, or it can keep consolidating in this range for a while until the data works itself out. We kind of see where the economy is going in terms of getting into the fall, when the student loan repayment starts, when people come off summer vacation, start reeling in their spending because of the holidays coming up. In the meantime, you have the housing market. Mortgage rates are at all record highs right now, 7.22%. I don't think we've seen a 7.2% mortgage rate and I don't know how long it's been, but definitely it hasn't been in the last 10 or 15 years, maybe the last 10 years. So that's putting pressure on the housing market, which is reducing inventory. Higher rates equals less inventory because people are locked into lower mortgages. They're not going to put their house on the market when the rates are this high because there's no inventory out there. There's nowhere for them to go, and they can't move. So it's going to take a while. To correct the housing market, these rates are going to have to stay above 7% for a longer period of time. You can still buy new homes. where builders can buy the rates down into the 4s. So there's still new home sales are outpacing resales because of that reason. And there's just less inventory in the resale market out there right now. So when you add that to the seasonality of the summer, the real estate market always slows down in the summer. That really compounds things. So I think we're going to get a lot of answers as we get into Q3, Q4 in terms of where the economy's headed, where the markets are headed, where the housing market's headed. Pivotal time, critical time. So let's jump into the charts and see what's going on. Of course, this is the Dow right here, and I've been tracking these Fibonacci retracement levels from the all-time high to the low back in October. And so far, the Dow has retraced back to the 702. It's lost it 1, 2, 3, 4 times. It rejected, and then today found support right on the 618. So these are important technical levels, the Fibonacci retracement levels. You have the 4, if the 618 is lost, then you have the 0.5. And that's where I was talking about ranging. You could see, even down to 382. This could just kind of range in this area between the 382 and the 702. The 382 was the last line of defense that held back in March. So we could potentially see a return back to the 382 and then just kind of range from there. Whereas the NASDAQ has cleared the 702, did not reach the 786, but hasn't retested that yet. So the NASDAQ is still in good shape right now. S&P has lost the 702 and is below it. So, lost it here, broke above it here briefly, and then lost it. So that is not good for the S&P. The NASDAQ, of course, we have the big 7 carrying the weight of the NASDAQ here, and Apple, Nvidia, the tech stocks, kind of leading the charge there with the AI revolution. And let's go ahead and jump down here, take a look at the VIX. We did have a volatility spike today, but quickly rejected back down to the 15.26. It spiked up to 17. So, back in those March timeframes, you were back up here around a 30. So that's a long way to go for the volatility index. But you could potentially see a jump back up here into the 1920 range, which would bring you back to that 0.5. Well, definitely the 0.618, not necessarily the 0.5. You'd have to get back in this range to see that 0.5 Fibonacci level get hit. The Dixie kind of hanging out, but the 2-year popped today to an all-time high, has rejected. We'll see if it'll make another push as we get into the end of the day. This is why the mortgage rates are up, because the 10-year is heading back towards that 5%, 4.3% range. And, we'll see if it gets beyond there. That's what mortgage rates are loosely based on, is that 10-year yield, from a risk-free investment return scenario. So let's take a look at Bitcoin. Bitcoin has kind of rolled over. It spiked yesterday on the news from BlackRock's CEO, Larry Fink. He came out and talked about Bitcoin, how he's changed the entire outlook and thesis, how BlackRock has changed their entire outlook and thesis on Bitcoin, talked about the ETF. And of course, this is what has, propped prices up so much, is all the ETF talk and expectations. And again, if the ETFs do get approved across the board, you have everybody applying for them now: Vanguard, Fidelity, BlackRock, ARK. There's Grayscale's trying to convert. If they all end up winning their case, well, not winning their case, but getting their applications approved, if Grayscale wins their case, then you will see the floodgates open, and we'll probably see a nice spike out of Bitcoin. It could look a lot like Nvidia. We'll take a look at that in a second, but you could see Bitcoin. It could easily double and start testing previous highs if those ETFs get approved, because it's just going to bring a flood of capital in the space. So when could that happen? Well, even if they give the green light, you'll start to see that get in front run, but the actual capital can't come into the market until everything gets approved, cleared, and ready to trade. That could take at the earliest 6 months, but most likely this process could be about a 12-month process, but it could happen by the end of the year. So we'll continue to track that. But as soon as you see positive signs that they are moving down the path of approval, more and more capital will come into the space. And, this level here could hold for Bitcoin for a while until the ETFs get approved. And then you can be off to the races, and you might even see, return to all-time highs even before the halving, which would be unusual. Typically, this is about where you would roll over before, the halving. Then you get the halving, and then Bitcoin goes on a bull run after that. But if these ETFs get approved, then this will be off to the races. And I think potentially, even if the markets are rolling over, if you get ETF approval, Bitcoin could sustain a potential rally, even if the markets are rolling over. But obviously, like we see today, Bitcoin is a risk asset. When the markets are down, Bitcoin's going to be down. So if the markets come under pressure and continue a decline, then Bitcoin can potentially return back to these, back to that level that we looked at earlier, which is about, let's look at it here. Let's look at the Fibonacci retracement from the recent low. What would that be? The 0.5 would be around $23,000. Well, the two, 0.5 would be 23,000. The 618 would be 21,000. The 702 would be 20,000. So they work in reverse, just like they do on the way up. So that's what we could look for there. And if we go back from this last run and just kind of look at from the previous high here, what Bitcoin has retraced so far from here is probably right at just about to the 0.5. So, these are technical levels, critical technical levels. That 0.5 right there level is a major level of resistance. And the 382 is a level of support that Bitcoin's been respecting here for a while. Ethereum continuing to plug along. Will the ETFs be good or bad for Ethereum? Well, there was 5 altcoins that were mentioned by the SEC. Obviously, Bitcoin, Ethereum. Well, Bitcoin's not an altcoin, but Ethereum, Litecoin, XRP, Dogecoin. They've survived the previous bear market. Solana, the SEC, did not indicate any issues with Ethereum in terms of becoming being labeled as a security. So Ethereum could benefit, from some of this bullish action, especially with some of the comments, made by Larry Fink from BlackRock about the technology and the space in and of itself. But right now, just a down day in general. Let's go ahead and take a look at Nvidia. And this is what Bitcoin could look like if that ETF gets approved. I mean, it could just take off from here and just run, another 200%, which again would potentially put it back towards, all-time highs. Now, I'm not saying that that's going to happen. I'm saying that that is just a potential. And what would that be? That would be about 120% from here if that ETF gets approved. And then once it gets to these levels, we just have to see where it goes from there. So could be a good opportunity. We'll just have to keep tracking that. But again, there's still a lot of road ahead. Larry Fink obviously said that we wouldn't have applied if we didn't think we could get it. Not those exact words, but that's basically what he was saying. So they seem very confident that they're going to get this approved, and the SEC didn't flat out, delay or, postpone anything like they could have. They just said, hey, we want more clarification. So the ETF applicants have all revised their applications to provide that clarification. So now we'll see what their next round of comments are. And it'll kind of be a game like that to where they'll make some adjustments. The SEC will say, hey, well, we want a little bit more clarification. They'll make those adjustments, and then things will continue on. The real question is, Coinbase is who everybody is naming as the custodian with this surveillance agreement. So, custodian of the assets. So the interesting thing is with the SEC and litigation with Coinbase, how will that play on things? So we'll just have to wait and see how this plays out. I'll see you in the next video.